Sounds good. If we want.
Right. Hannah, if you want to take your slide down and then we can jump into Jainaba's presentation.
Yeah. It's loading. Are you guys able to see my screen?
Yes, thanks. Looks great.
Hello, everyone. I'm Jainaba Njie, and it's nice to have you guys here with me today, just to share some gems and insights on other types of capital that might be available to you outside of VC. So before I get in to it, I would like if you guys have access to the chat, not sure, but if you could drop a one if someone has ever told you that you should raise venture capital, or if you thought about it. Okay, I'm seeing some view. Yeah. Well, here's what I do for a living. A lot of times I tell people not to. I mean, most businesses are not supposed to raise VC, and the fastest way to like waste time or even sometimes have your business going to the ground is getting the wrong type of capital. Because with VC comes a lot of things that maybe people might not be aware of initially, including giving off shares of your company. And shares is not just giving up a portion, but also control. And another thing might be having being able to not be able to return capital to investors as well. So sorry, I have this there. So a little bit of my background. Yeah. So I am an ex-VC. I've worked in both sides of VC, so people giving funds to VC, so more of a funds of funds and LPs. I worked for a 200 million fund in Barcelona called Oryx Impact. And then from there, I joined the Global Venture Capital Fellowship, where I was mentored and also did apprenticeships with VCs globally, including in the US. And then from there, I became a venture partner at a 20 million fund and did a lot of investment committee analyzing startups, but also deciding whether or not to invest. And then from there, I saw there was a huge gap with all the startups coming in, and it's like they didn't really have the information of what we expected from them in terms of documentation, in terms of where we wanted them to be as a company. So with this, I decided to step back a bit and do some grassroots work, and that's how Elevate Consulting came about. And through Elevate, it's been around for 2 years officially, where I've done like 100 one-to-one calls with founders globally. Um, Throughout my career, I've done at least reviewed at least 500 pitch decks. So I'm really used to seeing different companies and just different gaps they come with. Yeah. So when it comes to raising funding, normally there's just one question people ask, who will fund me, right? What investor can I talk to? But that's a mistake that I say people should take back and step back a bit and look into 5 questions before figuring out who to talk to. And the first one is, how much of your company are you willing to give? Some people don't want to give initially any shares because maybe they understand that it does come up with having someone else be part of the decision making. And maybe some they don't mind because they have that mindset, just like maybe Elon Musk. Maybe having 1% or 2% of $1 trillion company is better than owning 100% of $1 million company. So the second would be, what kind of business are you building, right? Is it a business that you want to scale? Is it a business that, maybe it's more you want it to be sustainable, grow, pay your employees? So these are things you want to first, think about. And, in terms of money, it's more of like, what does the money look like now? Are you, making constant revenue, or is it more contract-based yearly? Maybe it's not inconsistent. It's a service business. It comes in waves. And for some, it's more of like, can I look into borrowing? You know, do you have assets, something that you can put forward in case, you know, as security, just for the banks to feel safe that you will pay it back. And also, what is the money actually for? I think everyone gets excited for raising, they want to grow, but maybe sitting down and looking into your company to see exactly how that money will be distributed. So I did create a tool called Capital Fit Tool. It does dive deeper into these 5 questions. It's not 5 questions, it's maybe like 15, but it goes deep into your business. I will share the link after for you to try, and it would diagnose your company, tell you more about whether you should raise or not, what type of capital you need, and also what type of business you are. So if you look at some of these questions, I'm sure some of you can answer it in your head right now, but there are maybe 4 answers you might come up with, you know, still figuring it out. Some people want to scale and others have room to grow. And so some people just want a steady business. And none of these is the right one. Um, it just depends on, you know, where you want to head to. So here you have some business street. I don't know if you can, sorry, let me just hide my, yeah, sorry. Yeah. So these are 3 different types of companies, and some chose the right capital, some didn't, and yeah, some chose right. So the first one is Amicale. It's an American beauty company, very niche, tailored to women of color, that recently shut down last year. Amicale, you know, was catered to a smaller pool of, you know, a demographic, but went for VC money. And initially in an interview that was done with her last year after her close, she did mention she didn't want actually a rocket ship version of a business, but still was pressured to go towards VC, angels, and it closed. Funnily enough, the business was still doing well. It had sold out orders, but between the orders and from customers and ordering from the suppliers, that gap, the capital needed for that was what she didn't have, right? And also the VCs were pressuring her to open more doors in stores. And so with that, she wasn't really able to get capital from her business to reinvest back to buying new supplies. And then with that, she had to force herself to close. If I was supposed to recommend the right type of capital for her, it would be using money against the stock she had, you know, going to a bank, trying to get a credit line or try to get some trade financing, or maybe at least angel investors who know the beauty industry and could guide her. Uh, and then you have Slack. I mean, most of us use it, right? It's a software company. It doesn't really, you know, it has no equipment. It can easily be scalable. And, you know, most people globally, you know, have a need for it. So I think venture capital money was the right fit for it. Um, it didn't need a bank. It didn't really have any assets to lend against anyway. And so selling its shares made sense because it didn't really have the capital to be able to pay maybe to be able to maybe pay employees. So it needed to sell shares, get capital, and use that capital maybe for expanding, paying employees or getting the product in place. And then you have a service business like some of you guys and mine as well, where you might have maybe 6 to 10 people or more, but you know you're steady, profitable, and you don't really have the assets or you know want to sell a large chunk of your company yet. So what I see and in my industry and what I see some of my clients doing is doing a credit line against their invoices. So more like they already have these invoices from contracts they have with customers, and they go to the bank and they open a credit line against that. So if anything happened, that credit line would be what the invoices would be what they would use to be able to pay off, you know, the credit line. So yeah, they're still open, still own 100% their business. There's no pressure to grow fast. Okay. Yeah, so one thing I would say is like instead of shopping for their type of person or investor. I think it's understanding what kind of money. So there's different types of money, like I mentioned, the shares, borrowing like debt, having money work for you. So using your invoices and maybe customer orders, and then maybe like revenue-based financing where you could use your profits to pay back someone like a strategic partner. And then grants, especially in sectors that have to do with healthcare, biotech, deep tech. And that money, I mean, you don't have to pay back, but it gives you time to be able to, experiment and be in more of a non pressure to give the money back. So who has the money, right? So we have angels, angel investors. They normally provide safes and convertibles and shares. So safes, for example, is more less risky for founders, but more risky for investors because there's no structure in terms of having to return the money back. So with convertibles, after a certain milestone, you might need to either return the money back or convert the shares that were agreed upon into equity. So then you have venture capital, of course, where it's more price rounds based on valuations. And they do sometimes use safes and in some cases venture debts and maybe hard, especially now there's a lot of hardware or hard tech companies. So venture debt can come into place because those assets, like as I mentioned earlier, could be used as leverage for debt. And then you have like private equity, and for those who initially maybe want to be bought out, especially maybe from an industry leader, they can come in maybe as a growth equity, come in with growth equity and take shares initially, maybe 30%, 20%. And then from there, they might then slowly buy you out. And then you have strategic partners. So let's say for companies like Amicole could have worked with maybe the supplier, do a contract for revenue-based financing. So the supplier could give them credit and then they pay off based on the revenue get later. And then banks and lenders as well. A lot of people stay away from banks because of the high interest, but you can leverage banks, especially if you're asset heavy, and you can use that as leverage to be able to get loans and paid back, especially if you have recurring capital that you could pay it off with. And then, of course, grants, matching grants are available too. A lot of development institutions, governments, they provide these grants as well, depending on the sector and the problem you're solving. I guess two warnings, a merchant cash advance is not revenue-based financing. And, you need to ask for annual rates for that as well for the changes. And there's no federal grant for general working capital. So these are things to know. Outside of just like figuring out the type of capital, I think it's important to also get that investor fit. So once you figure out like, okay, I would like to get venture capital money, then let's say you have to figure out the thesis, the stage and the ticket size. And this will kind of like cut down your list on who exactly, what type of investor you should go for. Within VC, for example, because a lot of VCs have different theses. Some people just want to invest in AI, fintech. Some people would look into companies who are asking for less than 10 million, 20 million. The stage as well, maybe only growth stage. So you want to save time by being able to shortlist your list and using these as well. So if you want to know like where these investors are, I mean, maybe some of you might be familiar with PitchBook, Deal Room, OpenVC. These are like platforms where they have all informations of VCs and private capital investors. And then for angels, locally, they do have angel syndicates. So just looking into your local directories and seeing if there's any groups of angels. Friends, family, and fools also could be angels as well. family members, or just high network individuals within your network, friend of a friend. It's always good to start with your network, even if they're not as able to give you capital, they might know someone who could. You also have grants. So as I mentioned, government websites, there's grant.gov, banks and DFIs. So these are for large projects that have collateral and you're asset heavy and can pay back. So they're normally just regional. So like the IFC, World Bank, it just depends on where you are. Market intelligence, just being aware of what deals are out there, what funds are being closed. So TechCrunch, maybe sharing maybe new funds and just keeping track of those funds to reach out to. And of course, the warm intro route, which is through other founders who maybe got investments from other type of investors, advisors. They might have networks of those accelerators as well. At the end, might have a pool of investors that they bring into who are interested in their cohorts, and yeah, existing investors. Yeah, so as I mentioned, I'm gonna drop it here in the chat, the Capital Fit tool, and you can play around with it and just let me know your feedback on that. But I'll leave the rest to questions. So yeah, we can go from there.
Awesome. Jainaba, thanks so much for the presentation. Open it up to questions. You're welcome to put those in the chat and or just raise your hand or unmute yourself. We're a pretty low-key group, so feel free to unmute yourself and talk over each other if you've got some questions. Oh, thanks for putting your contact in the chat, Jainaba.
Yeah,
Maybe
sorry,
one
that's
question.
the toolkit, sorry, that they can have access
Oh,
to
that's the
later.
toolkit. Gotcha. One question I had as you were going through in terms of a steady state, or I think you called it steady company, if you require a small amount of funds to get to that steady state, can you talk through in a little bit more detail, what the options are for getting $500,000 to initially kick things off in your company?
Okay, yeah, so it depends. Are you just starting off, or you're probably at a growth stage looking to scale and need some capital?
Let's say just starting off.
Okay, so starting off as an SME, I think what you should look into first is working capital, right? So, and most of these working capitals banks offer. So they normally offer it like a credit line. So they know that the capital is more of for OpEx, like for operations. So it depends if you are an SME, right? So if you're on startup, I'll go into that separately. But as an SME business, there's two angles. So banks, not as debt, but as a credit line, right? And but I would advise for you to first maybe have one or two invoices from customers or contracts, something to show that you can pay back that working capital credit line. They normally provide between maybe, at least with a client I'm working with right now, he's requiring some working capital and he's looking for 250K. So right now the bank is looking for some cash conversion metrics that he needs to provide to just show how fast he can pay back his business. His business is an agribusiness, so he exports dried mangoes into the US. So he's looking for some capital to help with the operations, buy the mangoes, pay the employees. And so the only option at that short amount of time is going towards the bank for working capital. Now, if it's a startup, of course, it's most likely very tech software. There's not much to give. You have subscriptions, but it doesn't really say you pay off, you pay off the working capital. I would look into the angel investment side. So there's a lot of angel syndicates. So more of like a group of individuals maybe have extra cash, putting it together and then looking for a few companies to invest in. So I would say that's what I would go for. Yeah.
Great, thank you. There are a couple of questions in the chat. Rather than me reading them, Jainaba, maybe you could take a look at those and address those as they come in.
Sure. Second. Okay, so I don't know. Is Karen? Yeah, they're asking for work with deep tech startups and mentioned grants are a good way. Do you have any other insights you can share for early stage deep tech? So I think one insight I would share for deep tech is looking to see how you can get patents. So when it comes to just post grants, you want to plan for post grants, so more like institutional investors, and they need some type of way to maybe have some moat that you can share in place because at least for deep tech now, depending, I don't know if it's hardware, software, um, it depends on hardware or software, but you do need a moat, right? And you do need to show how you differentiate yourself. And I think if it's hardware or maybe deep researched deep tech companies, working towards a patent helps put your case in front of investors post grants. If it's software, it's more of like trying to find some way to show some proprietary IP or just way to show how you can be able to go through the sea of competitors right now. And I mean, deep tech is very like, let's say for AI companies right now, there's a lot of them, but how do you differentiate yourself, right? Data might be moat, in some cases, but you might need to find proprietary data. So not only data you get from the internet, but maybe having solutions where data privacy and it's more of a vertical for your clients. So if you're in a health tech, deep tech company, showing ways that maybe only you can access information from your clients and it's not available somewhere else for competitors, might put you ahead. So it's, I think for deep tech, yes, grants are good initially for research, but once you want to scale, I think it's more focusing on showing the moat, especially in a very competitive landscape right now. So.
Yeah, great answer. I think also a couple of our attendees here have gone through that path. I know Christian Iverson has received a grant doing some research. So that path is definitely available. Let's see, is it Treya or Trey Tolbert?
Freya, yes.
Treya, thanks for your comment here. Do you have any questions for Jainaba or thoughts around those offerings that you suggested?
Yes, so the offering, if we look at Boxable, right, they provided a very specific strategy that exempt offerings, they utilize their customers actually as investors, which is very interesting, specifically for us as a B2B business. That is an offer that we are actually working on, and we have gotten some really good feedback. So that is something that is not as dilutive as a VC and provides early founders, startups with the capital they may need to go fast or build faster.
I definitely agree with you. There's this new way capital structure, like it was not new, but it's not well talked about, called revenue-based financing, right? So it's more of like, let's say you are a manufacturer, you have a supplier that provides some goods products to you. You could create a revenue-based finance contract where they provide you some financing, maybe at a lower interest rate, where you can pay off over the months rather than going to the bank. Or like you mentioned, customers as well. So yeah, it just depends on like the type of business.
Great
Specifically
points.
for hardware, Jainaba, thank you for that feedback. Yes, specifically for hardware, I think everybody who works on hardware like we do, that component, we negotiated 8 weeks terms, and that helps us a lot. So, and most, I think most manufacturers, if you build with them a relationship, will help you in that area.
Agreed, agreed.
Jainaba, can you share maybe some of the most common mistakes that companies make as they are looking for funding and how you would suggest avoiding some of those mistakes?
Yeah, I think one of the mistakes is getting into the wrong rooms, which we covered today. But another mistake is looking for funding when you're not ready, because it really wastes everybody's time, right? And when I mean ready, it's not like in terms of like revenue milestones. It's just having structure. So having your financials in place, having your legals, everything in a room so that when an investor, when you come in front of an investor, they have something to look into to assess your business. Because at the end of the day, everyone wants a return, right? It doesn't matter if it's a bank, everyone wants something back, unless it's grants, of course. But I think one mistake founders make is just going out to speak to investors. And once they get the interest, then it takes even longer now because they have to go back and scramble, get everything together. And I think even one of the clients I'm working with right now, that's happened. We finally got an investor to be interested. And for months, I've been trying to get everything in the data room in place, dragging him for information. Of course, he's the founder, is busy, but what I'm always telling him is like, look, I know you want to raise capital, but for it to be really fast, if we have this data room, we could just go and just sell. It's like sales, right? You already have everything in place. You meet the investor and you close fast. Or even the bank, anyone you try to go up to will want to look into something. And everything's not organized and scattered. It's going to take longer, and it's just ends up either you lose momentum with an investor, they don't get interested anymore, or it's going to take longer for you to get that money. So I think one mistake is going out there without having your house all a mess, right? If you have guests coming in later, you're gonna scramble all over. So yeah.
That's a great point. A couple of weeks ago, we had a session on how to build a due diligence room, and Devin Solberg went through how he has done that in the past to raise funds and how he's currently doing it in his company. And that what you're touching on there is definitely critical.
Yes.
We've
And
got
another part would be governance. I think a lot of people really don't take it as seriously when it comes to even having some board of advisors or advisors in place. Depending on the stage, early on is not as bad. But if you're a growth stage company, especially working maybe in the asset side, or you in the hardware side, and you most likely have to go into banks, they're very strict when it comes to governance, because governance is more of making sure there's something keeping you accountable for your business. Decisions are not being made on the fly. There's systems in place, there's people in place. Um, so I think that's one thing that I would advise, especially if you're a growth stage and maybe on the hardware side, and most likely would face banks.
Yeah, that makes sense. Thank you. We've got a couple minutes left. Jainaba, do you have any parting thoughts or suggestions, anything that you would leave with the group as they are looking to bring capital into their companies?
Yeah, I think there's three things I would just advise. I think first, figuring out whether you actually need capital, because sometimes you don't. I know it's a weird thing to say, but how can you use some of the cash flows? Like just checking to see where your business is first is important, to see maybe if there's extra cash. And like Treya mentioned, maybe your customers or people close by can quickly help you fix milestones. So I think, I would advise first to check that. Second, what we talked about today, what type of capital, and then of course investors. And the third is just like making sure you're ready before going out there. But yeah.
That's awesome. Paul, thank you. Paul McCarran came in with a question in the chat right under the line. Do you mind taking a minute to address that, Jainaba?
Okay. It says not actively looking for funding, but would be open to it with the right investor. We are early stage but profitable. Okay. Though we are finding it difficult to scale as quickly as we'd like due to the noise in the vertical of software. We have just opened up some edge case markets and have a secondary fundraising tool. What would you suggest would be the best type of capital? I mean, if you're not looking to scale, well, you said you're having difficulty to scale. I guess the question is, will you be able to scale eventually? If so, I think,
Possibly, but it's taken a long time due to the amount of noise in the core market.
okay. But your business is scalable though, if maybe the right strategy or the right distribution channels are
Yep.
given to you.
Yep.
Yeah, Yeah, I think early stage, I think what I would advise is maybe getting an angel investor who is very familiar with your market and will either help you provide you with the right distribution channels to sell your software or connect you with the right people to help you remove that bottleneck. So remember, investors are not just for capital. They can come in for some of these bottlenecks you have and provide distributions. Let's say you were couldn't get a license for something, they could come in. So I think when also trying to get an investor, don't only look at the capital, but see what else they can provide. And I think in your case, maybe looking into someone who can help you with the bottleneck you have, right? I mean, it's a crowded uh, industry you're in, but maybe find someone who has access to distribution where, you see, I don't know, A16Z, they have for example, I'm not saying you should go, you can go there, maybe speed run, but they have huge distribution. You see them always sharing some of the startups that they're in their portfolio. It's not just because or for show, they're actually putting it out there so they could draw customers to them. So yeah, maybe looking into someone with distribution or someone who can help you remove that bottleneck with the resources they
Yep.
have. Yeah.
Thanks very much.
Yeah.
Jainaba, thank you so much for your time. I know we went over, but thank you all for sticking around with us. As a reminder, we do this every week at the same time, same bat time, same bat place. For those of you who are Batman fans. So look forward to having you back. And Jainaba, thank you again. If people want to get a hold of you, do you mind dropping contact information in the chat?
I'm gonna drop my LinkedIn. I share just weekly resources and just anything to do with raising capital. So it's free. I mean, so I'm gonna share my LinkedIn with you here. There's also the capital tool that I shared earlier in the chat. So it's just for you to play around and feel free to give me feedback on it as well. But yeah, it was really nice to meet all of you. I'm trying to get my LinkedIn link on here, but it's not loading. Maybe, yeah.
We can send it out as well, especially if you're going to share the presentation with Hannah. She'll send that out to all of the attendees and they can reach out to you.
Okay, sounds good. Nice to meet all of you. And yeah, I hope this was helpful a bit.
Definitely helpful. Thanks all. We'll see you later.
Take care. Bye.